These cards do not have to lose value to cost you money. They can stay at exactly the same price for an entire year. They can even go up. And holding it can still be the wrong decision for your business, because the cost of holding a card is not just what you paid for it. It is what that money could have done somewhere else while you were waiting. In the last video, I talked about the difference between spread and velocity. Spread is how much money you make. Velocity is how quickly your capital becomes available to use again. This is where those two ideas become practical. Every time you decide not to sell a card, you are making an investment decision. You are saying, I believe the return from continuing to hold this card will be better than the return I could earn by selling it and using the money somewhere else. Most sellers never state the decision that clearly. We usually say, I'm not selling at that price. I think this has more room. I'll wait until the season starts. I'm not in a rush. And look, those may all be reasonable, but waiting is still a choice, and that choice has a cost. Let's say you own a graded card with a cost basis of $500. You could sell it today and receive $650 after fees, shipping, and the other costs of the transaction. That means you could recover your original $500 and realize $150 in profit today. But you believe the card will rise over the next year. You think that if you hold it, you may eventually clear $800. At first, the decision looks obvious. Sell today and make $150, or wait a year and make $300. Holding appears to produce an additional $150, but that comparison is incomplete at best. If you sell today, you do not just receive the $150 in profit, you also get the original $500 back. That $500 can now be used again. Suppose your business can realistically earn a 15% net return every 3 months by purchasing and selling other inventory. Not every seller can do that, and some can do better, and some are definitely going to do worse. The important thing is to use a return that is realistic for your business. At 15% per cycle, $500 produces $75 in profit. If you can complete 4 cycles over the next year, that is $300 in potential profit using the same $500. I'm not even compounding the profits. I am assuming you continue redeploying only the original $500. So now the comparison changes. If you hold the slab for a year and sell it for a net $800, you make $300 on your original investment. If you sell the slab today, realize the existing $150, and redeploy the recovered $500 4 times, you could make another $300. That path produces $450 in total profit. The slab did not decline, it increased in value. You still made money holding it, but holding it left approximately $150 of potential profit on the table. That $150 is part of the holding cost. A useful way to think about it is holding cost equals the profit you could reasonably earn from the best alternative use of the capital, plus any direct cost and additional risk created by waiting. Or, more practically, required future net proceeds equals what you could net by selling today, plus the return you could reasonably earn by redeploying the capital, plus any additional cost or risk from continuing to hold. So in our example, you could net $650 today. You believe the recovered $500 could generate $300 over the next year. That means the slab would need to produce at least $950 net 1 year from now for holding to outperform the alternative, not $800. Approximately $950. And that's before accounting for any additional risk. The card may have to appreciate much more than you initially thought just to make waiting the better business decision. This is where sellers often get anchored. You paid $500. Someone offers you $650. You believe the card may eventually be worth $800. So you frame the decision as, do I want to make $150 now or $300 later? But your original purchase price is not the only number that matters anymore. Once you can sell the card for $650, you are choosing what to do with an asset that can currently produce $650 in usable cash. Keeping the card is economically similar to choosing to invest $650 into that card today. That does not mean you should always sell. It means the decision should be evaluated against the card's current value, not only what you originally paid. Okay? So ask yourself, if I did not already own this card, would I use $650 of the business's cash to buy it today? If the answer is no, you should seriously question why you are continuing to hold it. Ownership creates attachment. Cost basis creates anchoring. Neither one automatically makes the card the best place for your capital tomorrow. Opportunity cost is usually the largest piece, but it is not the only one. There are also direct carrying costs. So you have all kinds of things, okay? Insurance, storage and security, your marketplace subscriptions. A lot of you guys have inventory financing, the labor costs required to keep listings current for you and your employees, the cost of repricing, relisting, transporting, and eventually fulfilling the item. For one card, those costs may feel insignificant. Across hundreds or thousands of cards, they become very, very real. Then there is risk. Player performance changes. Injuries can happen. Populations of that card are going to increase. New products are going to compete for attention, and demand is going to move to a different player, a set, a character, or a category. You see it all the time. The market does not have to collapse for the card to become harder to sell. A card can maintain its apparent market value while its actual liquidity deteriorates. The last public comp may still say $800, but if there are 20 copies listed and no recent buyers, that $800 is not necessarily available to you. Holding exposes you to the possibility that the future price never arrives, or that it arrives without a buyer willing to pay it. A business should not use one universal required return for every item. A highly liquid card may deserve a lower expected spread because the capital comes back quickly. A speculative card should require a higher return because the outcome is less certain. A strategic showcase piece may provide value beyond its initial sale price. So, and a personal collection card does not need to pass the business return test at all. The important distinction is intentionality. If this is operating inventory, it should have an expected return and an expected time frame. If this is a strategic hold, it should have a thesis and a reevaluation date. If this is showcase inventory, you should be able to describe what it contributes to the business. And if it's personal, call it personal. Don't be including this stuff. The trouble begins when ordinary resale inventory sits for years and gradually gets reclassified as a long-term hold because it just didn't sell. That's not a strategy. It's an explanation created after the capital has already become trapped. You don't need a complicated financial model for every card. You need a hurdle rate. Now, a hurdle rate is simply the minimum return required to justify keeping your capital in a particular investment. So start by looking at what your business can realistically earn elsewhere. Not your best flip, not a perfect month, okay? Your repeatable return after fees, shipping, mistakes, and unsold inventory. So suppose your business can reliably earn 10% every 3 months. If you are considering holding a card for another year, the card should not merely increase by 10%. The expected return should compete with several potential inventory cycles and compensate you for the additional uncertainty. The less liquid and more speculative the card, the higher that hurdle should be. You do not need to predict the future perfectly, and none of us can. You're trying to make the trade-off visible. That's the goal. For any meaningful card you are considering holding, write down 5 numbers. 1, your cost basis. 2, what you could realistically net by selling it today. 3, how long you expect to hold it. 4, what you expect to net when you eventually sell. And 5, what the capital could realistically earn elsewhere during the same period. Then, compare the outcomes. Do not compare the future sale price only against what you originally paid. Compare holding against the best realistic alternative available to the business today. Sometimes, the card will still deserve to be held, and that's fine. The point is just simply not to force a sale. The point is to require the hold to earn its place. Every slab in your inventory occupies more than physical space. It occupies capital, and capital has a job. The card does not have to decline for holding it to cost you money. It only has to underperform what the same capital could have produced somewhere else. So before you say, I'll just hold it, ask one more question. What does this card need to be worth in the future for waiting to actually pay off? Because holding may feel passive, but financially, it's an active decision.